Welcome to the Final Bar. I am Greg Schnell, the host of the series. This week, we're going to cover off lots. This is the show where we check out the most interesting charts to get set up for the following week. With some intermarket studies, we'll be finding out the inflection points for minimum risk and maximum reward. This week, we've got a few of them, and we want to drill down on those as much as we can today. So we're going to talk about some of the bullish signals that just showed up on the NASDAQ literally yesterday, today. And commodities just got crushed. They got thrown out with the bathwater yesterday. And that's a real area to avoid, I think. I was hopeful that gold would be making a low here. Still holding some of them, but it's a tough one to keep holding. Bonds, which direction is the breakout? It's at this thin edge of the wedge, and it's either the yields are either going to break out to the upside or roll over again to the downside. So we'll see which way that wants to go, and I really don't have a feel for it. I thought last week yields were going lower, prices were going higher, and now this week it just seems to be right stuck in the middle. So we'll talk about that. And the U.S. dollar is slightly higher this week, but I have trouble believing that's the whole reason for the pressure on commodities, because it's literally slight that it's higher. Okay, first of all, I want to talk about the indexes themselves, and this is a real simple version. So up here we've got an RSI, and down here just regular price with a 100-period moving average in the green line here and a 34 EMA. And as all that is it's a real quick look at how the S&P is doing. But down here I have a PPO set up based on the 60-minute candles and then the rate of change. And what you can see here in general is we've got a rising PPO. The momentum keeps rising, and it looks like it's ready to cross back above here. Now, when it doesn't cross back above here, that's when we get into trouble. And what we're watching for, we have this big swell, and then it comes back down. And as it comes back down, if it doesn't regenerate its momentum, usually you end up with a bit of a pause for 1 to 2 weeks, a month. We don't really know. So if I just roll this chart out to, let's just roll it out to 2 months. And there's a reason to cover this off. So maybe I'll make my dotted line a little stronger here. Let's just dash solid thick, and we'll get rid of the 34 EMA because it's a little too quick for what I want to cover off today. But what you see here is when we're above the 200 or above the 100 EMA, the market's pretty good. And then when it starts to get below here, you'll also see we had negative momentum coming across here after swelling up to this high level. We pulled back and we really couldn't get going again. And so the market spent 3 weeks in a downtrend. Then literally we surged back above the 100 EMA, and we went on a bit of a run, spent a week making higher highs. And as we got to this high, we started to have less momentum, and that ended up being the final high for a few days. And then we rolled down, and we've continued down. So just drawing simple trend lines across here, gives you some good clues of when to be looking for breakouts. And so we currently have a trend line that we can draw on here. And the point I want to make is things look very bullish right here. And the reason is if it turns and bounces up, we would really like to be on board. On the other hand, if it rolls over here, it's starting to suggest we don't have momentum to go higher. And the problem with that suggestion is we're in the middle of earnings season. So this actually happens pretty quick. Yesterday, it looked like things were rolling over quite hard, and then all of a sudden today we tried to rally. But as you can see, we got back pretty much what we lost the day before and a little bit more. But we have a lot less momentum on this high, which is fine. But we need to see it bounce off this line and keep going. So as I roll out this chart, let me just add some time to it. So we're going to go back to the beginning of the year now. And the point is, what you see on the chart here is we have these periods where we have lower momentum. This is just a 60-minute chart, but we have lower momentum, and all of a sudden the market corrects a little bit. Over in here, we were just kind of wobbling, and we started to make lower lows and lower highs as the market was making higher highs. And all of a sudden, literally just kerwump. And once it hits this zero level, usually it's a place to at least be aware of the potential for the market to break lower. So we have a nice big trend in this area that's going higher. And we also have, of course, this 2,800 level, which has been friction. Now, everything I think about would be, what would the computers want this market to do? And I think at least they want to go up a little bit higher, because if they can push the market, for just even 10 points above this level, so 28.10, you'd get a lot of short covering and probably go back to test the prior highs. The real problem is do we have the momentum to do that? And what you see on this momentum indicator is that when we get to these sort of frothy levels, the market has a little bit of trouble going higher. So it can pull back, make another rally up, and you can see here briefly shot to a new high and then gave it all back. It's not easy. It doesn't make the market any easier, but I just think it's always important to be aware of the short-term momentum. What's it trying to do? And so we've pulled back from the highs, and now we're trying to accelerate up. As we try to get through this 2,800 level, the market as a whole needs to get, I'll call it a spirited rally going. And Dave Keller, who will be speaking at ChartCon 2018 in a month, if you can believe it, it's already here. Dave Keller put out a tweet yesterday saying that 98% of the S&P 500 gains between the beginning of the year and now are all out of 6 stocks. So if you take the total market cap, half have dropped and half have gone up, and those two have kind of balanced off, and then the remaining 6 have made the incremental move in the S&P 500. So we're up roughly 3% from the beginning of the year. So the beginning of the year was here, and we're just up a little bit from that. But the point would be, if you're not in those 6 stocks, you basically, if you had a balanced portfolio, you probably have chop and haven't made any money. So a pretty important thing. Now, if we change this to the NASDAQ, what we see here is this stock, or this index, is trending a lot better. It's trending higher. And as we run up here, now we're taking out the prior highs here, and we, pretty well past this one. This is 71.86, and we're at 73.50, 73.60. So we're a full almost 200 points higher than this high. But in general, we're seeing higher highs and higher lows. We haven't seen that in the S&P yet. But the one thing that I do notice in the markets is normally when we finally top out, one of the things that will happen is that one market will go on its final run and the other markets won't participate. So we just talked about the S&P 500, and I'll just flash back to that. So we just talked about the S&P 500, and here's the high. And so we haven't been able to get there. Here's the Dow Jones Industrial. And clearly we're not getting there. The Russell has recently made a high. So that's bullish. And what we want to watch for now, as an example, let's say that the NASDAQ kept going and now the Russell stops participating in this rally as well. We'd start to lose the breadth that we've been enjoying in this rally, especially off the April 1st low. And as we rally up here, I've been convinced that we'll get some sort of rally into earnings, and we'll see how that works out tomorrow. We've got 3 banks reporting. But the big issue here is if we stop seeing, the third market out of 4 start to underperform, I think, that's when we start to wonder what's going wrong, that all of a sudden the only thing that can go higher is the NASDAQ. So I still want to be bullish, and I still want to try and ride this earnings rally through. And if I just shrink this chart down to back to the 10 days, which is usually what I look at it as, you can see that the PPO has come down, is resetting right around 0, and can rally from here. That's very bullish. There's no reason not to expect this market to try and rally. But if it doesn't, if it just comes down and then rolls over and goes negative, that's a pretty clear sign investors are backing away from that part of the market. Briefly. Now, again, let's go to the NASDAQ 100 and just locate the PPO. And you can see we're still higher highs and higher lows. We're trying to get back up to this higher high. And, even if we wobbled in here, it would be okay. We just don't want to get into this negative territory. But anytime we get a lower high, we want to watch for that sort of misalignment of the markets. But again, we've got 2 of the markets nowhere near their prior highs. The Russell and the NASDAQ both at their prior highs or higher. And if the Russell was to start falling away here, then we have to start being worried about how the market is showing its strength. And so those are bigger pictures for us. And let's just roll out to something simple like going back to 2015. Maybe I'll just use a weekly chart here. The point I want to make is back in 2015, so April was an earnings period. Basically, May, we couldn't do anything with it. And then we got into July. I just want to zoom in here. Whoops. Just want to zoom in on this July. What you see here is in May, we made the high. We came into July and we tried to rally. And so the first week, the second week, we rallied up. The third week, we got up here. And this is right when options expiration would be. And then you start to weaken. So I'm very cautious about options expiration, because I think if the market separates more, in other words, the Russell starts to fall away and only the NASDAQ goes higher, I'd be worried that we're going to kind of make it to next Friday and probably have more trouble. If everything can start to participate, so the S&P break to the upside, the NASDAQ break to the upside, and Russell breaks to the upside, whatever, we all start to see these markets making higher highs and higher lows. Even if they're not both making highs at the same time, it's got to make higher highs than the previous area it's been in. So it'll take us a while to see if that's really how it wants to work out. But we had great participation in a bunch of stocks today. And one of them was the, let's just go here. One of them was the, Microsoft just continues to be a powerful stock heading up to the highs here. And really, since Satya Nadella got on board, this thing has just been a powerhouse. So we're up here around $100 and no signs of breaking down. Amazon's breaking out. A lot of the game producers are really starting to look nice. Here's Electronic Arts. That chart looks so stable and easy to own. So there's lots of good things to notice here. I want to show this particular point on the chart. So here we see there's a big uptrend in momentum. And right at this point of the uptrend, so we have a high and then a lower high in here. So maybe I'll even draw these lines in. So I've picked something neutral like Electronic Arts, just so you don't know it's one particular index or something. But what you see here is we briefly rallied above this point, came up, and then immediately rolled over. And on that rollover pretty much marked the final high for that stock, and it started to continue down. Indexes are a little more diverse, but it's always worth watching. So if we go look at the NASDAQ, it did something today, and this is what I referred to in the opening, did something today that's quite bullish. And what that was rather than after making a lower high here, it looked like it was going to start turning down and go below the signal line. It's actually turned and rallied up. Now that in particular is, in my opinion, is very bullish. So I just want to go mark this off with a little bit of changing the chart period. So I changed it from 5 years to 3 years. And now what I want to do is show that when this line is breaking this way, so momentum was lower, and now we're starting to go higher. And it's this kind of little flicker that I want to watch for, because if this is going to return to new highs, so kind of like it did in here where it pulled back and then all of a sudden got here, kind of wiggled around, weren't sure which way it was going to go, and then it took off to the upside, that's a great place to get on board. And we're just trying to break through the 7,200 level on the NASDAQ. So getting through that is pretty important. And having the momentum actually start to break a previous trend line is a good thing. And you can see we could have, drawn this trend line in here. We could have drawn this trend line in here. All of these are great places to get on board. And so the big point I want to make is I'm bearish if this rolls over, and that could be next week, but I'm bullish as long as it starts to break out to the top side. And the reason is because these things can put on another 6 months or 9 months or 3 months of runs. We really don't know. But when they're running, you want to be on board. And the best signal we could possibly get, or one of the better signals, is when it's starting to break out above this previous downtrend in momentum and breaking out to new highs. That's really, really bullish. So right in here, we did the same thing. We were trying to break out to new highs. And so as we did that pretty much end of October, bing, and on it went, and it was a pretty good run. Back in here, pretty much right in here, we broke out. So I hope you get the idea that I'm not trying to be bearish. I'm just trying to be defensive if the market isn't going to participate. So if it does this and just rolls down, I don't really want to own it. But if it's going to go the other way and start to break out to the top side, we do want to get on board. So if I sound wishy-washy, it's because if the momentum fades right here, I'm out. But if the momentum can keep running, I definitely want to enjoy that. And so I think it's pretty important to understand why I'd be so skeptical with two of the markets already not following the NASDAQ and the Russell to higher highs. So if the Russell starts to fade away and only the NASDAQ's making higher highs, that gets concerning. But obviously, we'd still expect good earnings from Apple and Amazon and the big players. But if too few stocks are running this whole thing, then we start to see the index roll over, and eventually even the strong stocks start to wane a little bit. So those are the kinds of things that I'm looking at here as the market tries to break out to higher highs. And I hope that makes sense. So if it sounds like I'm, one day I'm bullish and one day I'm bearish, it's because, well, every time this signal is generated, I want to make sure that I'm on the right side of the signal, and I don't really need to own it if I'm not. So I made a chart here, and I just want to go find it. This is what happened to the commodities this week. And so in here, I've got all of these Goldman Sachs commodity indexes put side by side, and I'll be covering this in the commodity countdown on the weekend. But yesterday was a pretty decisive day, and so it's an important thing for us to cover off today. So energy was in an uptrend in 2014 and then obviously broke down. And here in 2016, we had an uptrend, and now 2017, we had an uptrend. And if I zoom in on this, we're holding on this line so far. So that's an important one. But when we look down the right edge of this chart, we can see that this one, precious metals, has broken. Industrial metals, I've been talking about that. That one's broken. Here is the livestock index. It's broken. Here is the agricultural index. That's pretty much broken after 6 months. And here we go back on a one-year trend line for the whole total return on the commodity index. And you can't see it on this chart, but if we zoom in on the last part of that year, that chart is broken. So the issue we're having, and again, just going to scroll down to the bottom here, when you draw these lines on 7-year charts and then go to the 1 year, you might not have placed it tight enough. But the point I want to show here is the total commodity index is starting to break down. And when you're doing that, maybe you get this little breakdown, but I think the real concern I've got is that everything is doing it pretty much the same time. I mean, this agricultural index broke down at the end of May, and now these ones are breaking down the end of June. All of these are very important. And when, as a group, they all start to break, it tells us either the US dollar is going to go on a rip or people really expect something to be changing in the commodities. Anytime the commodities start to slow, and I want to use 2014, 2015 as an example, the big markets, the broader index might not fail at the same time. But one of the things that you can have, so here's 2000 and wanted one more year, sorry. The years are going by. What we see here is in 2014, all of a sudden this started to crack, and this started to crack, and this started to crack, and livestock cracked a little bit sooner. Agriculture was already well on its way, and the total commodity index started to break down, and this is in the July-August timeframe and in September. Well, when that started to occur, all of a sudden the markets got weak. Then we rallied back up into 2015 and made a slightly higher high than the 2014 period and rolled over. But in general, one of the things the commodity markets was telling us was that it was a bigger fall coming. And so the issue I have at this point in time, back in 2014, the banks had lots of support from the Fed because they were still pumping QE infinity, or whatever you want to call it, at that point in time. So let's just go to JP Morgan. What we want to note, so here's 2014, and the banks were just in this big, beautiful uptrend. Well, by 2015, they started to roll over midsummer. And so the quantitative easing ended in here, and the banks banks had a little bit more rally, but you can see they have pulled down instead, and they're right at this zero level. So if JP Morgan's going to bounce, I want it to bounce right now. So in essence, I'd put it right about this point or this point in 2014 and see if it can get some momentum higher. But the real problem we've got is if all of a sudden all of these banks start to fall below zero on the PPO line, I'm a little worried. So tomorrow we have Citigroup reporting, and this is a nice turn here. We're getting a higher low in the full stochastics and a lower low in price. That's positive divergence. We really like that. We haven't got the positive divergence on the PPO yet, but it looks like it wants to cross. So we're going to see what's going to happen on earnings tomorrow from Citigroup, and if they can start to turn up, that would be bullish. Really bullish, because the concern we have is all of these banks are pointed down now as these commodity markets break apart. And so here we see the same wave on Bank of America. It's right at the zero level, kind of like JP Morgan. We've got a lower low on the full stochastics, and it's trying to cross its signal line today. So we'll see if it can. It's at 1611. The signal line's at 1393, so it's starting to cross it. And there's also the 10-week and 40-week moving average. So there's a whole bunch of technical indicators that are starting to line up. If this can pop it all to the upside, we might get some more follow through. The last one is Wells Fargo. And on Wells Fargo, what we see here is this has been trending higher for pretty much 3 or 4 months, but we're in negative momentum area. So it really fell apart, we'll call it March, and then kept going down, and in May or whatever, it started to improve, and it's been climbing out of this hole ever since. So it's been rising for about 3 months. Tomorrow is a pretty important day when they report earnings to see if this can get any moxie to the upside, or is it going to be more like back in here where it just kind of rolls over at zero and fails, and then all of these banks start to drop down together? I don't have the answer, but we're watching hard for that tomorrow. Okay, some of the other things that I think are interesting is when we look at the big market, and there are so many people that are bullish out there, and on Twitter, what you'll find is some people are like so bullish, I just can't believe how stupid people are to be bearish or whatever. And on the other side of it is there's people who are so bearish they couldn't possibly see any sort of bull market outcome anytime soon. I'm trying to just use the charts to tell me which side of the fence to lean on. If the momentum starts to improve, I want to get back in the trades, and I'm almost fully invested here, but I want to stay with the market. And if the market rolls over, I'm just going to either move to cash or move to defensives. So here's what we see over the last 22 days. Just taking each sector and saying, how did it perform? So consumer staples was up, healthcare is up, and utilities are up. And if we right click here, we can put on the cycle line. And what we see here is when these sectors are in favor on the right-hand side, you're in a defensive posture. And when these ones on the left-hand side are outperforming, you're in a bullish market posture. So really quick, we're in a defensive market posture for the last month. Now, it doesn't mean it has to go on, but it definitely means we want to keep watching it. So let's go for 3 months. And what you see here was, stuff that was leading has really stopped leading in the last few months. So for them to have outperformed that much, that tells us how little performance we're getting out of them now. And if we compare it to the S&P 500, it makes it look even more glaring as to how much these are starting to move. Now, the S&P isn't equally weighted because obviously the big technology names are heavily outperforming the overall index. It's this in general, if you just took each sector, they're doing pretty well, but we have huge names like Amazon in broadline retailers over here, and it's adding a lot of pressure to the upside, which is good. But what I just showed you was how much those areas of the market have actually had been outperforming and are now performing at a lot less level. So we're concerned. Now, the financials over here on the right were really ugly, and they started to improve. So perhaps we're going to start seeing an adjustment in this scenario where the financials start to take off. I think the biggest message for the 12th day of July 2018, is we have a lot of signals telling us to be defensive. We have an entire commodities area that's broken. We have cyclicals and technology have been underperforming this month so far, even though they're making new highs. I get that. And we're starting to see maybe some rally in the financials. And so we just don't know how far all of this is going to go. So I'm going to go back to the NASDAQ chart and just show this on the 60-minute. So if we start to see the NASDAQ slow down here and get back below this 100-period moving average, I probably just want to at least reduce my exposure or put on some sort of an option to try and maintain it. Because what I'd be more worried about is holding it when all of these things are setting up in big pictures. And I've covered off the weekly and monthly indexes quite a few times, but the main look, just for the NASDAQ, do I have one here? The main look I want to show for the NASDAQ, just going out here, is that on these charts, this is starting to turn up here on the end. That's very bullish. But if it ends up making a third lower high here, so this is a high, a second lower high, and a third high, and rolls over, that would be a problem for us. And so we're at a delicate point in the market, and the backdrop seems so bullish. How could it get any better? And that might be the point. How can it get any better so the market actually takes time off to deal with that and then comes back in the fall and gives us a good rally or something like that? We just don't know. So all of that to say that we want to be careful here as the market goes through the earnings period. I don't think it's a slam dunk either way, and I just want to be on the right side of the trade. So hopefully I'm not coming across as too bullish or too bearish. But the issue we have is if we're not aware of how fine-tuned the market is right now. This was the April earnings period, and you can see here was the options expiration day. We ran up right into it, and again, that was this year. So everything seemed very bullish when we got to options expiration day, and boom, down, down, down. And for 2 weeks, we sold off. Now, we didn't make lower lows. But the more important part now is we're farther out to the right here. And if we can't keep making higher highs, then this is starting to be worrisome. So I'm not predicting that, but look at March, how hard that was. April sold off. In January, we rallied for about a week after that and then rolled off. So these options expirations are a pretty important place for us to watch. And we have about 1 week left. Okay, hopefully I've made my case for that. The last thing I'd like to just talk about briefly is Dow Jones US Energy. And what I want to talk about here is, we've got a triple top sitting in this market. And so as we go forward, we need to make sure that this actually keeps rallying. And if it doesn't keep rallying, this is a very important place to get cautious. And one of the reasons is the bullish percent index has started to wane. So we'll get a little weaker. And crude oil obviously had a disastrous look last week, yesterday, with this big pullback. And so one day doesn't make a trend, but you could see we had big moves down here, and then we spent 2 weeks consolidating. I think the bigger issue for me is just trying to figure out which way that crude oil wants to go. And we're starting to get this series of lower highs and lower lows on my PPO reading, which bothers me a little bit. I don't want to make it sound like it's overly dramatic, but as this starts to get weaker and weaker here, as you're making higher highs and higher lows, that's when we need to start watching out for it. So with that, thank you for joining us on today's show. The Final Bar airs live on Thursdays at 5 p.m. Eastern. It can also be found on the StockCharts TV schedule for your viewing convenience at other times during the week. It is also available on the StockCharts YouTube channel, and I post a copy on my Vimeo channel. So with that, have a great weekend and good trading.